In the previous 7 Federal Reserve easing cycles prior to this latest round, U.S. 10-year Treasury yields were consistently lower 100 days after the first cut. This time it's markedly different though. Not only are 10-year yields higher, but they've surged 120 basis points and are approaching levels unseen since 2008, despite the recent pullback. While this dramatic rise in yields could stem from various inflation concerns, one crucial factor remains a bit under-examined. Now, the Treasury faces the daunting task of selling bonds to cover over $1 trillion in interest payments in 2025 alone, while simultaneously needing to shift toward longer duration instruments to balance the previous administration's heavy reliance on short-term issuance. Now, this strategy risks deterring global bond buyers if they don't perceive genuine efforts to control spending. Now, several long-end auctions over the past 18 months have shown some lackluster demand, though at lower yields. Now, the pressing question now is whether these higher yields will attract buyers or if the market will demand some degree of fiscal austerity. Inflation, though, remains a paramount concern. Now, with the latest PCE data due out January 31st, market anxiety about inflation has eased somewhat over the past 10 days, following the better-than-expected CPI and PPI. Now, as for the January 29th FOMC meeting, expectations heavily favor no rate movement at all, with the CME FedWatch tool indicating a 99.5% probability of rates remaining unchanged. Now, if a trader believes that yields could be heading higher from here, they could express that by buying the January 10-year Treasury yield futures contract at 4.57 and targeting a move to the psychological level of 5.00. A stop for this trade could be placed below at 4.22. This trade can make $430 if the target is reached and risks $350 if you're stopped at your level. Now, if a trader believes that yields could be heading lower from here, they could express that by selling the January 10-year Treasury yield futures contract at 4.57 and targeting a move to the September highs of 3.92. Now, a stop for this trade could be placed above at 4.90. This trade can make $650 if the target is reached and risks $330 if you're stopped at your level.